unserer nächsten Referentin bei uns hier im Raum. Das ist der Peter Peterbos von Jupiter Asset Management. Wir erwarten auch gleich seinen Kollegen aus London dazugeschaltet. Den kann ich im Moment noch nicht zum Moderator machen, weil er noch nicht eingeloggt ist. Insofern würde ich Herrn Peterbos bitten, vielleicht die ersten Worte an uns zu richten. Und ich starte dann schon mal parallel die Präsentation und versuche mit seinem Kollegen oder jetzt parallel entsprechend hier das Login hinzubekommen. Ja, also Peter, ich übergebe an dich.
Super, danke Thomas. Ja, von meiner Seite, meine Damen und Herren, auch einen wunderschönen guten Morgen aus dem Homeoffice in der Nähe von Frankfurt. Ich habe jetzt gerade schon die positive Nachricht vom Talib Sheikh aus London bekommen und wir haben auch intern immer wieder mal Probleme, wenn es Calls und so weiter gibt, denn es geht schließlich durch den Kanal, muss man direkt so formulieren, und die Verbindung ist etwas länger, aber er hat den Link bekommen, er sollte drin sein. Der Talib wird auch gleich live zu uns sprechen. Lassen Sie mich ganz kurz vielleicht etwas als Thema sagen. Wir haben einen ausgewiesenen Multi-Asset-Experten bewusst dieses Jahr gewählt. Und ich will auch offen sein, der März war für Talib und das Flexible Income Team nicht ideal. Das muss man ganz offen sagen. Hintergrund ist einfach, dass wir im Rahmen des Crashes, den wir oder dieser temporären Korrektur, die wir gesehen haben, mit dem Markt 1:1 in Anführungsstrichen mit runtergelaufen sind und dann eine etwas andere Meinung gehabt haben zu dem Thema, nämlich, dass wir eben keine V-förmige Korrektur erleben, wie wir sie erlebt haben, sondern dass das Ganze realwirtschaftlich sich doch deutlich komplexer und deutlich schwieriger entsprechend darstellen wird. Und deswegen ist der Talib sehr, sehr konservativ in den letzten Monaten umgegangen mit der Asset Allocation und mit dem Portfolio. Und er kommt so sukzessive, wieder in das richtige Fahrwasser, mit anderen Worten, da im Quartil. Im letzten Monat haben wir das bereits geschafft. Im Jahr 2018 und im Jahr 2019 hatten wir ja zwei wirklich tolle Jahre mit dem Jupiter Flex. Und was ganz wichtig ist, soll jetzt kein Trostpflaster sein, aber ehrlicherweise muss man es so sein, noch eine Ausschüttung von 4,5% PA weiterhin anbieten und offerieren. Und ich glaube, das ist durchaus etwas, lassen kann. Talib ist, wie gesagt, seit Juni bei uns, bei Jupiter. Er war zuvor 20 Jahre bei JP Morgan tätig, unter anderem für den Global Income und in der Regel so knapp 400 Wertpapiere im Portfolio, über 12 Assetklassen verteilt, also Geschichte, die er sehr gut findet. Wir sehen, dass Talib zugeschaltet ist, ausgezeichnet. Damit würde ich mich, liebe Freunde, auch schon wieder muten. Möchte aber noch darauf hinweisen, der Alex Vasic und meine wenig den ganzen Tag entsprechend an unserem virtuellen Freund uns natürlich, ihn dort auch begrüßen zu dürfen. Vielen Dank. So I'm going to hand over to Talib and we're going to switch into English. Thank you very much. Good morning, Talib.
Good morning. Morning, everybody. I'm glad I made it a little panic just trying to log in at the start, but we're here. So really, thank you for taking the time to listen to the presentation this morning. We're going to talk a little bit about the way we think about delivering income and why we think that that's important. And then in the last stage of the presentation, just review performance through what has been a very difficult year for all investors. So for lots of reasons, I think people are looking forward to the end of the year. Just flicking through onto the first slide, I think it's probably worth just spending a second thinking about where we are. Obviously, we've seen a collapse in yields across the globe. We've seen negative interest rates become really commonplace. And even in the chatter that we're seeing now as maybe with a vaccine and maybe with growth looking a little bit better, certainly on our horizon, we don't really see a return to positive interest rates on deposit. We don't really see a return to yields being attractive across the government bond market. So we do think that this low yield world that we sit in is likely to persist for many years to come. And so you can just see the kind of investing landscape which we all face on this chart here. Bunds obviously showing negative yields. I saw that Spain and Portugal have gone negative now, and we would expect Italian bonds probably to go negative as well. So on the left-hand side of this chart, you can just see traditional sources of income compromised, and we don't think that they're coming back anytime soon. As we move to the right, you can see the yields which are available in European equities and global equities have continued to fall really as dividends have been cut post the crisis. And it's pleasing that our portfolio, the Flexible Income Fund, continues to deliver what we think is quite an attractive yield. Just over the last year, it's been just under 5%. On a forward-looking basis, it's just over 4% in euros, which we think is quite attractive. Now, clearly, we have to take some risk in order to gather that. We constantly say this is a medium risk fund, but the reality is that if you can deliver 4.5–5% for our clients, you need to take a moderate level of risk in order to be able to do that. So what are we trying to do? We're trying to provide a regular level of income over the medium term. We would hope also that we can deliver some capital return over that 3 to 5 year period. And we really would say that clients should have at least a 3-year investing horizon in order for this fund to be suitable for them. And I kind of think I will have done a good job, and the team will have done a good job if a client can give us 100 on day one, and they can receive that dividend check once a quarter of 4 to 5% over that medium term. And then they look at their statement in 3 to 4 years' time, and as well as that dividend check dropping through their post box every day, every quarter, we've been able to deliver some capital returns. So as well as receiving the dividend, maybe their initial 100 would have grown to 103, 104. It's never going to be 120, 130 because we're just not taking that much risk. So provide some income, that's the most important thing. And then also over the medium term, deliver some capital return as well would be very, very pleasing for us. How do we do that? We think my job really is to run around this triangle. At the top, you can see consistent, repeatable yield is the primary focus of the portfolio, but it's not the only focus of the portfolio. We also want to think about that capital return. So we want to allocate on the left-hand side to growth type assets. So typically they will be equities in the portfolio, because clearly over the medium term, we're looking for companies that can grow their earnings and grow their dividends. But we also want to think about risk management within the fund. We would say that this portfolio typically has a risk about half that of the equity market. So a volatility over the medium term, somewhere around 8%, about half that of the equity market. So a medium risk product delivering sustainable level of income. What's different, and really how do we try and differentiate ourselves? On the left-hand side, we want to be active. So within this portfolio, we have about 350 securities in it. That's very different to many of our competitors who will have 2,500 to 3,500. So in essence, they're buying the entire index. What we want to do is buy companies that we know very well, buy bonds that we know very well, and be very, very active about how do we mix and how do we tailor the mix of assets within the portfolio. We want to be flexible. We want to be quite agnostic about where we can gather income. As I said at the start, that traditional sources of income are compromised somewhat. So we need to look more broadly, perhaps to harness income from assets which are quite hard for the underlying clients to do themselves. So, for example, we have a very innovative sleeve which is looking at bank debt, financials credit, something which you find quite attractive. It's got quite a nice yield at 4.5 to 5%. We also look at things like emerging market corporate credit. We've also looked at infrastructure. So we're making sure that we're scouring across the globe for those attractive income sources. And then finally, we want to be disciplined, thinking about running a medium risk type portfolio. In terms of how do we do that, we really think about the world in 3 ways. First of all, our process is about, well, what do we think is going on in the global economy? And I'll touch on some of our current views in a second. Really what we're trying to do is work out what's the kind of 6 to 18 month horizon, and what does that mean for asset prices. We then want to think about how do we compare that to where market pricing is, and think about how does that mix of asset allocation evolve through time. And then finally, on the right hand side, we want to think about, okay, how do we build this portfolio? We don't want just to have a portfolio that's got one single asset class or one single bet in it. We want to make sure that we can mix those things together in a sensible portfolio. Obviously, we try and leverage the footprint that we have at Jupiter. So you can see my team at the top of this chart here. The people below that are what we call sleeve managers. So what we do is we give blocks of capital out to these people, and we allow them to pick those securities in accordance with their underlying process. So you can see our equity colleagues on the left-hand side, they will be running income portfolios for us. So think of it as like an institutional mandate that we give them. On the right-hand side, you can see our fixed income colleagues. There it's a bit more collaborative. We think about equities as being purely bottom-up instruments. So, they're deciding whether they want to own company A over company B. So move to the right-hand side, it's a bit more collaborative with our fixed income colleagues. We'll have a discussion. We actually had a meeting with Hilary Blandy, who is in charge of our credit sleeve yesterday, to talk about, where do we want to be on the credit spectrum? Which countries do we like? Where do we want to be from a sectoral? We had a big discussion yesterday about energy bonds, particularly, they've got really beaten up over the last year. They've rallied a little bit as we've seen the energy price rebound over the last month or so. So we had a good discussion about that. But what we do then is we allow them to go and select those individual securities. So by and large, if it's top down, if it's macro, it sits with my team. If it's bottom up, it sits with other people, and we can marry those two things together to try and deliver quite a nice diversified return stream. Where are we? And you can just see our process here. So one of the things that we do, we really look at each economy and each market through 4 lenses. And really, these are the cornerstone of our macro process. So we think about fundamentals. Where are we in the business cycle? Where are we in the economic cycle? Where are we in the inflation cycle? We then think also about policy. And, policy has been so critical this year, talking about not only what central bankers are doing and what governments are doing, trying to analyze how they are going to shape the investing landscape that we're existing in. We then look at sentiment. Clearly, we don't want to be in crowded trades. We want to be looking for the non-consensus calls. And then finally, we want to be thinking about actually, well, what's the price that we're paying for that asset? And each of these lenses has a slightly different time frame. So actually, valuation matters hugely on the very long term. It doesn't actually matter very much on a kind of out to 18 months. Over 10 years, it matters hugely. But out to 18 months, it has very little impact actually on asset price returns. Sentiment tends to be a bit more short term. Policy is in the medium term, and I would argue that policy at the moment is the most important driver of markets. And fundamentals, where we are in the economic cycle, they matter greatly over the medium and long term. In terms of what do we think at the moment, we don't sit with the doom mongers. We kind of think we're in a muddled through environment. We thought that prior to the vaccine news, which we had last week. We do think that we're in a muddle through, and ultimately, as we look through into the first and second quarters of 2021, we think that the global economy is actually healing to a greater degree. Clearly, Europe is in the depths of despair at the moment, I guess, with further lockdowns, and we think that that's a risk which could come across into the US. But when we take that medium-term view, we think that actually the economy, probably given the policy support which has been provided to it, actually probably is doing a little bit better than most people think. So, the doom mongers who are saying that we're entering into a second double dip recession, going to have a big credit default cycle, isn't something that we necessarily think about. Just moving on to that sentiment, I'd probably caution a little bit that that's become a bit more consensus. Clearly, we had huge moves in asset prices off the US election, a kind of relief that some of the more worrisome forecasts around that election were not realised. And then obviously we've had an additional boost with the vaccine news last week, and actually Europe, and I'll touch on this in a second, actually has been a huge beneficiary of that. So actually, weirdly, if you look at where assets are traded over the last few days, the S&P, the US equity market, is actually down quite significantly. But if you look across the Eurozone, it's actually up quite significant. So that that value has been realised there, and I'll touch on how we've positioned the portfolio to benefit from that. Those sources of income, as I say, they are the most important thing. You can just see here, we kind of break our assets into 3 types, really. One is core income orientated assets. You can see that they're typically fixed income orientated. You can see, we do have high yield. We have about 30% of the portfolio in US and European high yield. But those slightly differentiated yield streams, both in financial credits and emerging market debt, you can see actually they're giving us quite a nice yield contribution to the portfolio. As you move across to the right-hand side, you can see the equities in grey. Dividend orientated equities just really haven't worked this year. Certainly not until the last month or so. So really, equities came under huge selling pressure during the pandemic crisis. You then saw companies across the Eurozone actually slash dividends really quite aggressively post the pandemic. And the big debate we're having now is, can those dividends start to be reinstated? And we think that's likely to happen. We think that bad news around dividend-orientated equities is actually in the price. And certainly, if you look at the contributions to the portfolio return this month, and actually more broadly, you can see those kind of more yield-orientated equities, those more value-orientated equities, actually have done quite well over the last month. So, if I look at something like Spain, the IBEX, or CAC in Germany, they're up over 20% over the last month or so as the market started to kind of realize that the world's a bit better and actually look for things that are quite cheap. Contrast that with the US, the NASDAQ, actually, which is down over the last month because people have realized that it's probably overvalued. In terms of the portfolio, this just shows the mix. So there's two ways that we run the portfolio. On the left-hand side, you can see what we call our cash securities. So that's really the core heart of the portfolio where we're getting that yield and getting that growth. Blue are the yield assets, green assets, which are slightly differentiated, so things like our FX and things like our infrastructure plays. And then you can just see in grey the cash equities that we hold. It's about 20% of the portfolio in cash equities at the moment. I do anticipate that going up over the medium term. On the right-hand side, you can just see that we do use hedges occasionally. At the moment, we're short the UK. Just by selling some futures, and actually we'll use some futures to implement our asset allocation. So you can see Asian equities and actually in the US, rather than investing in the underlying cash equity, what we've just done is quite tactically just buy some futures there to try and get some growth. And certainly they've given us a nice lift for performance this month. You can just see how we move through time. The orange line in the middle just shows the equity sensitivity of the portfolio. And typically we would say that would be between 20 and 60%. So again, that kind of equates to that idea about the portfolio having a risk about half that of the equity market. You can see some of the tilts which we've made to the portfolio. I think this goes to the end of September. One of the things that we've done quite aggressively over the last month or so, actually we've been buying Japan. We've been buying some Japanese equity futures. They don't have much yield in Japan, so it's better to just quickly make that asset allocation trade using a future. And we've been having a big debate, and this is more of a structural call, really about European equities and should we be increasing our weight to there. And we've made tentative steps towards that, but certainly when we look at where valuations are and our view that actually the virus it isn't as bad as people think. Isn't as bad as people think. Europe probably is going to be something that maybe is really quite interesting. You can just see active currency. One of the things I think that's changed over the last 6 months or so is the usefulness of government debt as a diversifier has lessened. Clearly, if you're buying bonds at minus 50 basis points, their usefulness to trade in the opposite direction to equities is lessened. So as a multi-asset investor, it becomes harder for us to find diversification. And actually, we find currency actually is quite a good way of us building some diversification. So at the moment, we're long some Japanese yen, which is a traditional diversifier. We can also use currency to try and give us some additional yield. So we own a little bit of Mexican peso within the portfolio to give us a little bit more yield. Really, dividends are the thing that is the core of the portfolio. You can just see the return, the distributions that we've made in the portfolio over the last 2 years since we've been running it. Fairly stable at around 4.5. I don't really see that changing over the medium term. We do think that we can find interesting ideas. We can still find selected bonds and selective companies where we think that the dividend yield is quite attractive, and certainly that's something that we're constantly looking for. In terms of risk, on the left-hand side, we just measure the standalone risk of each of those allocations. And what this does is it just allows us to compare things that are quite different. You can see that one of the biggest risk positions that we've had at the moment, it's actually been reduced since we took this snapshot, actually is in US equities, because we think they can give us a little bit of growth. They don't really give us much yield, and that's why we'll use a future to do that. Places where we really are running most of our kind of yield orientation, you can see in high yield, financials, credit, and also on a gross basis in European equities. In terms of our performance this year, I mean, it's been a difficult year for us. I think we've had, I think this is where we have to put our hands up and say we underestimated the scale of the pandemic going into March. And clearly the portfolio, because of the type of assets that we hold, certainly did draw down from that. But the bounce back has been relatively muted. I think we've been in a strange period, certainly through the summer, where actually yield-orientated assets really didn't work at all. And so what the market did was, in the recovery phase, they wanted to buy the longest duration assets that we possibly could. And so, you know, the most obvious way was the massive outperformance of the NASDAQ, which you can see on the right-hand side. So market really just wanted to buy things which have very, very long, very distant earnings stream. And they didn't really care about dividends because they were looking for those long-dated assets, which were going to benefit from the fall in real interest rates. And so you can just see on the right-hand side, there was a real gap opened up between yield-orientated equities and more growth-orientated equities. And we think that that yield, that gap between the two is closed. And I suppose the most stark way of demonstrating that, this snapshot is to the end of October. If I look at the performance month to date, it's been very, very stark. So as I say, you've had, you know, some European equity markets up 20% while the NASDAQ's been down. So we certainly benefited from a closing of those jaws, and the portfolio actually has done pretty well. God, sorry. Apologies. And the portfolio has done quite well since. The portfolio has done quite well over the last month or so. In terms of our return, you can see that drawdown during that summer period, and you know, we've lagged our competitors certainly during that bounce back, particularly those that didn't have a yield focus. But certainly month to date, the portfolio has done a decent return, and actually the portfolio is positive year to date. So if I look at the returns of the portfolio over the last year, over the year to date, they've recently just gone positive. If I look at the total return of the portfolio since inception, it's a positive return of 8%. You can just see where that performance breakdown came from over that period, and really this just illustrates just how much those those income-orientated equities have really struggled to bounce back until quite recently. So certainly when I look at the performance of the portfolio month to date, we're up, you know, over 6.5%, which takes us to a near positive number year to date. And certainly that's something which, you know, we think has got further to go when I look at where value is in the portfolio into year end and into 2021. We would think that actually we can follow through on that aim to deliver a repeatable level of income to our clients, plus the prospect of some capital growth as well. That was all I had to say in terms of the presentation. I'd be more than happy to take any questions if there are any.
Thanks a lot, Talib, for your presentation. Actually, I don't see questions yet regarding to your presentations. So if there are no further questions, I would say I hand over to Peter, if he's still available, or to the booth, also zum Stand, den Jupiter ja auch bei uns heute auf der Messe hat, den hoffentlich dann die meisten auch finden können auch dort Fragen beantworten lassen. So thank you, Talib. It was a pleasure to have you here. Originally, we planned to have you in Berlin, and we hope that it will be possible next year if the vaccine is deployed all over Europe, so the travel bans and the restrictions will be gone. So thank you very much. Und ich übergebe nochmal an Peter, vielleicht für 2 abschließende Worte. Und